Welcome to the 2015 Entercom Oil and Gas Conference in Denver, the 20th year of the conference. I'm Angie Austin with Oil and Gas 360, and we're joined this morning by Alan Bay. He is the Chief Executive Officer of Rock Energy. Welcome, Alan.
Thank you.
So you said this is the second year you've come to the conference?
Yeah, that's right. We were here last year. Had a really great reception.
And you're the founder of the company. You started the company 12 years ago?
That's correct, yeah. It was in the fall of 2003 or 4. Yeah.
Well, let's start with a little question about the Viking asset, shall we? After Q1, you had announced that Rock's drilling program for the second half of 2015 would focus largely on the Viking asset at Onward, Saskatchewan. Can you lay out the project for us and give us a drilling update as well?
Sure. We actually took the initiative to increase our capital program in the first half of this year. After that board meeting, we increased it by $15 million to 40 from 25. Our objectives were two strategic things. One is we wanted to complete the construction of our EOR facilities at Ontario LaPorte so that we could get the lower royalty rates. But the other strategic objective was to prove and to deliver lower cost structures on our Viking wells. We ended up drilling 13 of the wells, and the cost came in at 20% lower than we were originally forecasting. So we actually were very happy with the results that we generated. Well results were very positive, actually better than our more normal type curves, so we're actually, again, very happy with that. And the other thing that project did was further delineate the pool, the Viking pool. We now believe we have 40 sections of land oil charged in the Viking, which would generate 600 to 800 drilling locations. So we now have a very significant asset that we've been able to prove up through that project.
Excellent. All right, let's talk about the factors that led to you increasing your 2015 Capex.
Yeah, like I was mentioning, we had these strategic objectives. We were able to actually hedge into a rising oil price in the second quarter. So we actually hedged 2,000 barrels per day of production till the end of this year. That's provided very significant comfort and assurance of our cash flow. One of the things we do at Rock is watch our debt. So we wanted to make sure that our debt wasn't going to get out of line with this increased capital program. And again, remember that capital program was increased because of those strategic objectives, not necessarily to build production.
Interesting. All right, let's talk about cost-cutting steps a little bit. So far, 2015 has been a year filled with cost-cutting, as you know, across the industry. So what steps have you taken to reduce costs in your operations, and what additional efficiencies are you targeting?
Yeah, we're looking at costs on a couple of different levels. First of all, we look at our cash costs on a per BOE basis. In other words, our operating costs, our taxes, our royalties, our G&A, our interest costs. For the last 3 years, we've been able to reduce those costs by about 10% per year. But this year, we're actually able to reduce those cash costs by 30%.
Right.
Now, the main way that we were able to do that was one of that strategic objectives, the EOR project at Ontario. Once we started polymer injection, our royalties there went from 25% to 1%.
Oh.
That was over $10 a barrel in netback increase. So again, very significant project to help increase the resilience and strength of our company, especially in this low price environment. The other area that we wanted to focus on cost management is in the capital costs. And again, that was where the Viking project came in, and we did demonstrate a 20% reduction in the total cost to drill and complete and bring on stream a well there. So we're making progress in that area, but want to keep moving forward. We think there's further areas that we need to keep working on, but so far, so good.
Excellent. You mentioned Ontario. Can you update current production and catch us up on the Ontario LaPorte EOR project?
Yes, actually it's a very significant cornerstone asset for the company. Back in March we initiated a polymer injection. In order to do that, we had to convert 12 of our producers to injectors. So we lost production. Our production from the pool went from about 3,200 barrels per day all the way down to, at one point, 2,200 barrels per day. Since that time, though, we've been able to repressure the reservoir, and actually we've seen GORs come down, we've seen fluid levels go up, and we've seen production responses on the offsetting producers. We're currently doing about 2,650 barrels per day from that pool right now. Now, part of that project was to continue to restore that production through the drilling of infill locations. We decided not to do that. We're focused on getting the pressure maintenance in place to get the sweep patterns established. And once we start to see better oil pricing, then we'll go ahead and start to drill the infill locations and restore the production back into the 3,000 barrel. But we're not in a rush to do that until we see some decent pricing. The other thing that we wanted to do is we watch water cuts. In our pool, water cut is measured as a function of how much breakthrough or how much polymer injection is going on. We've been seeing our water cuts climb from about 7-8% up to that 10-12%. This is exactly what we were expecting. Our water cut is exactly where it was supposed to be, and we're seeing the pool is responding just as we hoped it would. So we're actually very happy with the results we're getting at Mantario.
Excellent. All right, let's talk a little bit about the balance sheet. Can you talk about the company's liquidity and your approach to the balance sheet?
Yeah, Rock's a very conservative approach to debt. We always try to be between 1 and 2 times debt to cash flow. So we'll limit our capital program in order to make sure that we stay that. Now that's well below our bank lines. Our bank lines are at 80 million. Our quarter-end debt was 65. We're forecasting year-end debt to be between 60 to 62, well below the 80 million. So we don't have any real concerns there. What we always want to try to do, and the way we did that is when we saw an increase in our capital program, that's why we put the hedges in to make sure that the debt would stay down low. So we're very comfortable with our liquidity and our ability to execute our program. For the remainder of this year, we're only going to be spending about another $5 million, so our debt level is coming down throughout the rest of this year.
All right, let's look ahead a little bit. Can you discuss your view of 2016, what your plans are for Rock Energy looking past, hopefully, the downturn?
Yeah. Well, it's an interesting couple of quarters that we're heading into. We believe at today's oil prices, we're probably at or near the bottom. And as you move forward into 2016, you see the one-year strip sits at about $50. In my opinion, the world can't replace 93 million barrels every day for $50. So it's not really a sustainable long-term price. For the next 2 quarters, we're going to watch and see how that transpires. If it is a new world of $50 oil, then what we'll have to do is have to work to get our costs down into that range. For Rock, because we have a very low decline rate, our corporate decline rate is only 15%. At $50 WTI, we could spend our cash flow and hold our company flat by drilling our Viking wells. So we are very, very, very sustainable at this level. But we don't think that's where we're going to actually end up.
Excellent. Well, I enjoyed speaking with you. Alan Bay, he is the CEO of Rock Energy. I'm Angie Austin with Oil and Gas 360. Thank you very much, Alan.
Thank you.